Are you a fresh graduate? Do you want to fulfill your educational aspiration by pursuing higher education in various interdisciplinary and multidisciplinary areas like environmental science, environment and occupational health, philosophy, sustainability science, folklore and culture studies? If yes, the School of Interdisciplinary and Transdisciplinary Studies offers various programs like Master's Program,
Very good afternoon, learners. Welcome to today's session. And today's session will be based on capital structure. And this session is continuation of our previous session. That is why the name of this session is Capital Structure 2. You can refer the previous session using the link which is provided on the screen. And this is available on YouTube for our learners so that they can refer the previous session and they can continue this session. So in previous session, we talked about resources of capital, wherein we talked about debt and equity. Then we continued the session while discussing the factors which influencing the capital structure, which includes internal factors as well as the external factors. We also talked about the capital structure which is called optimal, and this is the capital structure which helps us in increasing the value of the firm and reducing the overall cost of capital. We talked about the essentials of optimal capital structure, and we just started with the theories of capital structure, in which we talked about the net income theory, which is called the relevance theory of capital structure. Why it was called the relevance theory of capital structure? Because this theory says that when we are changing the capital structure, it is impacting the value of the firm as well as overall cost of capital. So net income theory and traditional theory, these two theories are the relevance theories of capital structure, while net operating income theory and Modigliani-Miller theory, these two theories are irrelevant theories of capital structure. So we talked about net income theory in our previous section, and today we will continue with our net operating income theory. So let's start today's session with this theory called net operating income theory. Now, according to this theory, the net income theory says that the total market value of the firm is not affected by the change in capital structure. That means whatever your capital structure be, if you are changing the capital structure, it is not going to impact the value of the firm, and the overall cost of capital will remain fixed irrespective of debt and equity mix. That means, again, whatever our capital structure, it is not going to impact the value of the firm and overall cost of capital. So whatever percentage of debt or whatever percentage of equity we are using in our capital structure, it is not going to change the value of the firm and our overall cost of capital. Just like we use the formulas for our net income approach, we will also use the same formulas in net operating income approach for calculation of V, that is value of the firm, which is equal to overall profit, that is EBIT, and it has to divided by overall cost of capital. Then value of equity can be derived from value of firm, which we have calculated in this formula. So our value of equity can be equal to value of firm minus value of debt in our capital structure. When we are talking about cost of equity, this can be calculated by deducting the component of debt what is the component of debt here? That is interest. So this is our profit, and out of our profit, if we deduct our interest amount, the remaining part, which is EBT, this is something which is available for our equity shareholders. These are the earnings which are available for equity shareholders. And if we divide this value by E, that is value of equity, we will get overall cost of equity. So this is what our net operating income approach says. So according to this approach, net operating income approach, KO will remain constant, and therefore there is no optimal capital structure. That means there is no structure that we can say is the optimal one, because whatever ratio of debt and equity we are using in our capital structure, be it 50-50, be it 20-80, be it 75-25, whatever ratio we are using for our capital structure of debt and equity ratio, it is not going to impact the value of the firm as well as overall cost of capital, and therefore we can say that no capital structure is a very good capital structure or the optimal capital structure. Let us try and understand the concept of net operating income with the help of this example here. So a firm has an EBIT of rupees 2 lakh and it belongs to the risk class of 10%. That means KO is given to us. What is the value of cost of equity capital if it employs 6% debt? That means KD is given 6% debt to the extent of 30%, 40% and 50%. So there are three cases for which we need to do calculation in this question. And the total capital fund that is available for this question is rupees 10 lakh. Now let us see the solution of this question. So we will start the question using the EBIT. So EBIT is given as rupees 2 lakh. KO is also given in the question 10%. So using this we can calculate the value of firm where V is equal to EBIT divided by cost of capital. So here we can divide our 2 lakh rupees by 10%, and using this we get the value of firm, that is V, which is equal to 20,000. Debt is in case 1, since we are solving this for our case 1, debt here is 30% of capital. The capital amount was 10 lakh rupees, which was given in the question. So 30% of 10 lakh is rupees 3 lakh. Now we will deduct 3 lakh from 20,000 and we get the value of equity, that is E, as 17 lakh. Now EBIT is given. Out of this EBIT we have to deduct interest. Interest, that means KD we have to use here. KD was 6%. Our debt is 3 lakh. So 3 lakh multiplied by 6% will give us our interest amount that we will deduct from EBIT. And we get this value 1,82,000. So this is our EBT, earnings which are available for equity shareholders. Now this EBT will be divided by the value of equity, that is E, and we get the value of cost of equity, that is 10.71% in this case. So this is case 1. Now using the values which are given and in the question and the values that we have extracted just now, we can calculate WACC, that is overall cost of capital. So this is something we have studied in the topic under the topic cost of capital, that how we can calculate WACC. So here we use the ratio of debt in our capital structure and ratio of equity. Ratio of debt needs to be multiplied by cost of debt and ratio of equity needs to be multiplied by cost of equity. Here in case 1 we have debt as 3 lakh rupees. It has to be divided by 20 lakh, which is our overall value of firm. This will be multiplied by cost of debt, which is 6% here. And we will add to this equity ratio multiplied by KE, which we have just now calculated. Now by solving this equation, we get the value of KO or WACC, which is 10%. So this is the solution for case 1 when our capital structure has 30% debt. In our capital structure, we have 30% debt. In case 2, it is suggested that this debt amount has to be increased from 30% to 40%. Now in this case, when the debt amount is increased from 30% to 40%, the solution will be like this. EBIT is again given as 2 lakh rupees. KO is 10%, and using this we have calculated V, overall value of the firm, which is 4 lakh rupees. Now E, we can calculate the value of equity can be calculated by deducting the amount of debt, which is 4 lakh. From where we received this 4 lakh, the overall capital amount is 10%, and in case 1 we have 40% as debt. So this is our D. We already have V. V minus D, that means value of firm minus cost of debt, will give us value of equity. And also we have this EBIT, we will deduct I, interest, from this. And from where we can calculate interest, we have 4 lakh rupees debt, and this 4 lakh has cost of debt as 6%. So 24,000 is available as interest amount here. So 2 lakh minus 24,000 gives us 1,76,000. This is our net profit, or we can call it EBT. That means earnings which are available for our equity shareholders. This 1,76,000 has to be divided by 16 lakh. That is value of equity in this case. And we get the value of KE here, which is 11%. Now putting the value of debt, which is 6%, and putting the rate of debt KD, which is 6% given to us, and 11% KE, which we just now calculated in our equation for calculation of WACC. So here in this case we have 4 lakh rupees as debt, and we also have this 20,000 as our overall value. This has to be multiplied by KD, which is given as 6%, plus 16% is the ratio of equity in our case 2, divided by 20,000, that is value of our firm, multiplied by KE. Okay, that is 11%. Now by solving this equation, we get this value of overall cost of capital, that is 10%. So when we are moving from case 1 to case 2, we can clearly say or we can see this, that there is no change in cost of overall capital. So in case 1, when debt was 30%, overall cost of capital was 10%. Now in case 2 also, the overall cost of capital is 10%. Let us check this for case 3 as well, when our debt is 50%. So in this case also, we have EBIT as 2 lakh, KO is again 10%. Using this, we have calculated V, value of the firm. Debt is 50% now, it is 50% of 10 lakh rupees. And using this, we can calculate E, that means V minus D, value of firm minus value of debt, will give me value of equity. I also have EBIT, which is rupees 2 lakh, and I have to deduct interest out of this. Interest will be 6% of my debt. So 6% of 5 lakh, which is 30,000. By deducting interest amount from EBIT, we get 1,70,000. Okay, this is my EBT. Now these are the earnings which are available for equity shareholders. Now this amount has to be divided by value of equity, that is 15,000 in our case, and by solving this we get the value, the cost of equity, which is 11.33%. Now all we need to do is we just need to place the values in our WACC equation. So in this case our debt is 5 lakh divided by 20 lakh, that is our V, overall V, multiplied by our KD. Ratio of equity in this case is 15 lakh divided by overall value multiplied by KE, cost of equity. Now by solving this equation, I again get the value of KO, which is 10%. So from this again we can say that whether the debt is 30% in our capital structure, or the debt amount is 40% in our capital structure, or the debt amount is 50% in our capital structure, the condition will remain same. The KO remains absolutely same, and there is no change in cost of overall capital in this case. In fact, the value of firm is also not changing in spite of change in capital structure. So this is what our net operating income theory says. Now after this we have the third theory of capital structure, that is traditional theory. Now this is the part of relevance theory. Why? Because this theory also says that the capital structure, if we are changing the capital structure, it is impacting the value of the firm as well as overall cost of capital. But yes, this theory says that this impact will remain up to a certain extent. So according to traditional theory, a firm can reduce the overall cost of capital or increase the total value of firm by increasing the debt proportion in its capital structure, but up to a certain extent. That means the theory says, yes, it is possible. It is definitely possible to increase the value of the firm and to reduce the cost of capital by increasing the debt proportion in our capital structure. But this is possible only up to a certain extent. So it is not so that if we'll keep on increasing the debt in our capital structure, we will be able to improve the value of the firm continuously. This will happen up to a certain extent, after which this scenario will start reversing itself. Okay, the value of firm will start falling. So let us try and understand this with the help of one example quickly. And for this, we will use again the same formulas that we are using so far for the previous two theories. That means equity can be calculated by removing the debt, the part of debt that is interest from our EBIT and dividing it by KE. We'll get the value of E. The value of firm can be calculated by adding the value of equity and value of debt. And in case we need to calculate value of cost of capital, overall cost of capital, this can be calculated by dividing EBIT. It has to be divided by the overall value of the firm, that is V. So this is how we can calculate, or we can do the calculation for testing the traditional theory as well. Let us understand the concept of traditional theory with the help of one practical example. Now this example says that A Limited, this is a company called A Limited. Now this is having the EBIT of rupees 1,50,000. Now this company is contemplating redeeming a part of capital by introducing debt financing. Now they are ready to introduce debt, but presently it is a 100% equity firm. That means there is no equity, or I can say 0% debt in this firm at present. And since the debt is 0% at this moment, our KE is 16%. Now the firm is to redeem the capital by introducing debt financing up to 3 lakh. That means 30% of total fund. So let us consider, this is the case 1 actually, when there is no debt. This is case 2, when they are introducing 3 lakh rupees, that is 30% of the total fund in the form of debt. And they may go up to 5 lakh rupees, that is 50% of total fund. Let us consider this as case 3. Now it is expected that for debt financing up to 30%, that means for case 1, the rate of interest will be 10%. That means for case 1, KD is 10% and KE will increase to 17%. But if this firm opts for 50% debt financing, then the interest will be payable at the rate of 12%. Now this is for our case 3. Okay, so this was for case 2. And this is for case 3, where 50% of debt financing is there. So in this case, our KD will be 12% and our KE will be 20%. Now we need to calculate WACC and value of the firm for different levels of capital structure. Okay, let us see this with the help of the solution which is available on your screen. Okay, so this is how we can present this using a table. In first, we have this case 1 when there is no debt. Then we have case 2 when we have 30% debt, and then we have case 3 where we have 50% debt. Since there is no debt in case 1, the debt amount is 0. In second case, we have 3 lakh rupees as debt amount. In third case, we have 5 lakh rupees with us as debt amount. Rate of interest is, since there is no debt, the rate of interest is 0 in case 1. It is 10% in case 2 and 12% in case 3. This information is something which I already extracted from the question itself. 1,50,000 is EBID in all the 3 cases. So in first case, since there is no debt, so interest amount will be 0. In second case, the debt is 3 lakh and KD, rate of interest, is 10%. So our interest amount is 30,000, that is 10% of 3 lakh. In third case, we have 5 lakh rupees debt and our KD is 12%. So using this, we can calculate the value of interest, that is 60,000. We just need to deduct this interest amount from EBIT. So in case 1, I got this value as 1,50,000. In second case, it is 1,20,000, and in third case, we have this as 90,000. We have KE in first case as 16%. In second case, it is 17%, and in third case, it is increasing to be 20%. Using this, we can calculate our value of E. We already have EBT, that means earnings available for equity shareholders. This has to be divided by cost of equity, and using this we can calculate value of E, which is 9,37,500 in case 1, 7,05,882 in case 2, and 4,50,000 in case 3. So in this case, we have just extracted the value that we have calculated or given in the question. So D, value of D is given in the question, and value of E we have calculated in the previous slide. Now by using D, by adding D and E, we get the value of V, that is value of firm. So it is 9,37,500 in case 1, 10,05,882 in case 2, and 9,50,000 in case 3. Now using this, we already have EBIT with us. Now we have V also. Now using this, we can calculate KO, that is overall cost of capital. So here what we need to do, we need to divide EBIT by V to calculate KO. So in first case, EBIT was rupees 1,50,000 in all the 3 cases. So 1,50,000 has to be divided by 9,37,500 in this case, and we get KO as 16%. In this case, 1,50,000 has to be divided by 10,05,882 rupees. We get KO as 14%. And in third case, we have to divide 1,50,000 by 9,50,000. And in this case, our KO is 15.8%. Now from this, we can clearly see the application of the traditional theory, as it says, because in first case, when there was no debt, our value of firm was 9,37,500 and our overall cost of capital was 16%. And when we have increased our debt proportion from 0 to 30% in our capital structure, the value of firm increased. It has increased from 9,50,000 to 10,05,882 rupees. And overall cost of capital is reduced from 16% to 14.9%. So this is something happened when we have moved from 0% debt to 30% debt. But when we are moving from 30% to 50% debt proportion in our capital structure, the scenario is changing. The scenario is changing because in this case, the value of firm, which was 10,05,882 in case 2, when debt was 30%, the value of firm is now reducing to 9,50,000, whereas overall cost of capital is increasing from 14.9% to 15.8%. So see, this is the clear-cut application of this traditional theory, which says that application of debt or introduction of debt, or I can say increasing the proportion of debt in our capital structure, will definitely help us in increasing the value of firm and reducing the cost of capital. But this is possible only up to a certain extent, and this will not be possible after that, after a particular limit. So this was about traditional theory. The last approach, the last theory for the day we have is Modigliani-Miller approach. Now this is the extension of net operating income approach. So this theory is also a relevance theory of capital structure, because ultimately this theory will also say that whatever your capital structure is, it is not going to impact the value of the firm or overall cost of capital. Let us see how. So as I say, it is extension of net operating income approach, and it serves, or it shows the relation between leverage, cost of capital and value of the firm. Now under the given assumption, the capital structure and its composition have no effect on the value of firm, and there is nothing which may be called as optimal capital structure. So in this case also we can say, just like net operating income theory, as we can say that there is no optimal capital structure. So whatever our capital structure is, it is not going to impact the value of the firm and the cost of capital. Similarly, in the case of Modigliani-Miller approach, we may also call it approach. It also says that there is nothing which we may call a optimal capital structure, and whatever your capital structure is, ultimately it is not going to be impacted. It is not going to impact the value of the firm and overall cost of capital. Now there are certain assumptions of approach as well. Like it says that the capital markets are perfect in nature. The securities that we are dealing with are infinitely divisible. Investors are rational in nature and they are well informed. All investors have the same probability distribution about the expected future earnings, so they know what is about to happen. There is no corporate tax, and personal leverage and corporate leverage are perfect substitute of each other. So if you are borrowing fund or you are putting your own funds for the purpose, it makes no difference. Now this firm says that now if there are two firms which are alike, which are absolutely similar in all the respects except they differ in their financing patterns. Financing patterns means their debt and equity ratio. This is the only difference in two different type of firms, and their market value. These two are the only difference in the firm. Otherwise, these two firms are absolutely similar. Then the investors have the tendency to sell the shares of overvalued firm. Suppose the firm 1 is overvalued firm and firm 2 is undervalued firm. Okay, and what will happen now, since this is an overvalued firm, what will happen? The investor will start selling the shares of this firm. Since they are started selling the shares of this firm, so demand will decrease. Since the demand will decrease in this case, the prices will okay, so since this is an overvalued firm, the investors will start selling the shares of this firm and will start buying the shares of firm 2, which is undervalued firm. Now in this case, the demand will start increasing. Now since the demand will start increasing, the prices will also start increasing. But in this case, since the demand will start falling, the prices of in this case will also start falling. And the investors are started shifting from firm 1 to firm 2. And this is how this firm will become now an overvalued firm, and this will become an undervalued firm. So this will keep on happening. This exercise will keep on happening in the market till both of the firms will become equal in terms of their valuation as well. Now this buying and selling pressure will continue till the two firms have the same market value. And ultimately when firm 2 will become an overvalued firm and firm A will become, or firm 1 will become an undervalued firm, the reverse will started happening. Again the same circle will go on, the same vicious circle will work, and again the same situation will happen, that both the firms will come at the same level. Their market value will become same. Now that is why, as per approach, there is no optimal capital structure, and all capital structures are said to be the optimal one. So thank you, learners. This is all from my side for capital structure. We will see you in the next session very soon. Till then, happy learning.